Hello, and welcome to our weekly market alert video. I am Ken Moraif, and I am CEO and founder of Retirement Planners of America. And before we dive into this week's analysis, I want to wish all of you a very happy 4th of July. And I hope that this is a period where we can all set our political differences aside and feel like one nation under God, indivisible, with liberty and justice for all. So hopefully we can all come together and be proud of our country. We live in the most wonderful country in the entire world. I've been privileged to be able to travel to all four corners of the world. And there are a lot of beautiful places and wonderful things to see and do, but there ain't no place like the good old US of A. So I hope that we can again, set our differences aside and appreciate the freedoms that we have and enjoy the 4th of July together as Americans. And then let's go back to the fighting after that. So let's start off with what happened this week, and more importantly, what have we been doing this week, because we've been busy bees, as they say. First of all, I want to talk about what we've been doing. As you guys know, we've been talking about the fact that back when we were concerned about the debt ceiling, we were concerned about the inflation numbers coming in, and then the Federal Reserve's response to those inflation numbers. And so we reduced our exposure to stocks. We did not get out of stocks. We were in stocks. We just reduced our exposure to mitigate against if the debt ceiling turned out to be drama. Because in the past, we've seen that when there is drama, the market does not like it at all. So we wanted to protect our clients, or at least mitigate the downside for our clients. But on Monday, we are now past not only the debt ceiling, but the inflation numbers and the Federal Reserve's interest rate decision, and then the turbulence that usually comes right after the Federal Reserve makes their decision. So all that was passed. So on Monday, we are now fully back invested. We bought back in, so we are fully invested in our client portfolios, in our stock portfolio. That's been a very good move so far, because since then, boy howdy, the S&P, the Dow, the markets have been on an upward tear. It's been pretty crazy how much it's gained in just the last 4 days. So let's talk also then about the data that we got this week. So first of all, we got the numbers that came in on the growth of the economy, the GDP, the gross domestic product. Wow, strong numbers, surprising almost every economist out there, expecting the economy to slow down. The Fed's raised interest rates 5% in a short period. The economy should be slowing down. Well, it isn't. So that's bad news, because a rapidly growing economy brings with it inflation normally, and the Fed doesn't want that. So what does that mean? It means the Fed probably will have to raise interest rates some more, as we've been saying they would. Also this week, we got good news. Well, actually, we got bad news, which can be translated as good news, okay? The consumer seems to be slowing down. So their data on consumption came in this morning, and it looks like the consumer is slowing down. Normally, you'd want the consumer not to be slowing down, right? 70% of our economy is the consumer, but right now we want inflation to come down more than we want consumers to spend, apparently. And so that's perceived as bad news. So the economy is growing, bad news. The consumer slowing down is good news. Bad news is good news. And the other thing that came in is that inflation seems to be slowing down. So where we are with all of that is it fits right into our narrative, which is what we've been saying all along. And that is that we think inflation is going to come down. As you guys know, we've been remarkably accurate this year on our predictions on where inflation was going to go. And our fearless forecast for 2 weeks from now, when the numbers come out for July, or for June, announced in July, we think inflation, the CPI number, will come out under 3.5% from the 4% that it was sitting at last month. So we think that'll be well received. We think investors will take heart, and we think that'll be a good thing going forward. However, as we have also said, our fearless forecast is that will be the bottom of inflation for this year. We think inflation will start to creep back up again in the second half. And because of that, we think the Fed's going to have to raise interest rates more than the 2 times that are currently priced in by the markets and the bond market and all of that. So In sum, what does that all mean? Well, if I was the pilot and you are a passenger on the airplane, what I would say is fasten your seatbelt. It's going to be turbulent. There's going to be some rocky. It's going to get bumpy, but the plane's not going to crash. We don't see a big bad bear market coming. And we think we will get to our destination. And the destination is, of course, that our investments are higher at the end of this year than they are today. So we think that's the case. The trend will be up, but it'll be a very bumpy ride on the way there. Now, let's talk about the bond side of the equation. We currently are not in our bonds. Again, why? Because as the Fed raises interest rates, bonds tend to lose value. And if something's going to lose value, probably not a good idea to invest in that, right? So we've been out of bonds actually since last April. And we continue to be in that posture. We think the Fed is going to raise interest rates some more, and we think bonds will suffer because of that. So we continue to have our bond side of the portfolio in cash, which is a money market fund. And right now, earning around 5%, sitting there while you're waiting for the storm to pass in the bond market, not bad. So that's where we are. Now, if you are not a client, then we can't do all this stuff for you. And what we tell our clients is we want to worry about all this stuff so that you don't have to. We want you to go play. It's the 4th of July weekend. We want you to go and have fun and enjoy your second childhood without parental supervision. Let us worry about this stuff so that you don't have to. And we want to do that for you. So if you're not a client, I encourage you to go to our website. There's a link below this video that you can click on. Meet with one of our retirement planners. They are experienced in Social Security and retirement planning and all the stuff that possibly would be of interest to you. We'll build a plan for you, no charge or obligation. We want to help you. And if we can, that's fantastic. And if not, that's fine too. Either way, there's no charge, there's no obligation, and we will part friends. So take advantage of that if you can. Our website again is rpoa.com. And share this video with as many people as you would like, okay? We'd love to help as many people as possible. So again, thanks for watching this video. Happy 4th of July, and we'll talk soon.